Welcome to the Best of Investing. I'm Edward Brown, your host. Here's our format. A bunch of guys sitting around a bar. There's no bar. Having drinks. There's no drinks either. But we're talking business, and you, the audience, are listening in. The Best of Investing is actually a radio show that has been around since August 2010, and it airs every Saturday on Fox News Radio, 9:10 a.m. at 1 p.m. Now, we're not a political show. We're strictly business, so everyone will be happy with that. We'll have various speakers, guest speakers, attorneys, accountants, economic advisors. The cool thing about this is that you're actually getting to see scenes behind the scenes. So we all have headphones on because we're recording a radio show that is going to be airing on the air on radio. But in addition, you get to see what happens during the commercial breaks, how we prepare for the next segment. So it's a lot of fun. There's going to be a lot of levity because I like to try to throw a little bit of humor in there because, you know, just business by itself sometimes gets a little boring. So you got to always kind of break things up. Remember, I'm Edward Brown, wishing you the best of investing. Are you ready? Let's go. Well, welcome. You're listening to the Best of Investing on News Talk 910. This is the show where we present valuable information about real estate, the financial markets, and other economic business of the day. For those of you listening for the first time, here is our format. A few guys sitting around a bar having drinks without the drinks, talking business with you, the audience, listening in. And I'm your host, Edward Brown. I'm honored to have as my co-host Mark Hunt of Pacific Private Money, California's premier private lender, and Brian Burke of Praxis Capital. And today's trivia theme is unusual sports stories. I knew you guys would like that. Yeah. All right, here we go. Ordinarily, we have an extra guest in the studio, but today I'm going to be the guest. And so I'll interview myself as well as you guys. And what we're going to be talking about is the ins and outs of life insurance, because I've been licensed since 1984 and I've been quite an expert on life insurance for many years. And I want to share with the audience certain secrets to make sure that our listeners are not overpaying for their life insurance. All right?
And we're going to make this exciting.
We're going to try to make it exciting. Okay. So go ahead, guys. Shoot me with the first question.
Well, the obvious question, Edward, term versus whole life or universal life, what's the deal with those?
Okay. Basically, term insurance is for the term of whatever you decide you want to buy your life insurance for. So it could be you want to just buy a 5-year policy, could be a 10-year policy, or it could be what they call annual renewable term, which is every single year you get a new bill and it keeps going up in price. All right? It's got no value at all. Versus if you get something like whole life or universal life, you give the insurance company extra money, but your premium basically would stay the same and it could build up some value. And we'll get into that a little bit more when we get into other questions.
So when you said with the term insurance, if you're older, would the term premium be higher than for younger people?
Of course, because the odds of you dying are a little bit easier then, right? Except if you buy the policy when you're young enough, then you can get it fixed. So there are policies out there that you can buy a 20-year term policy, and if you're, let's say, 30, it's guaranteed not to go up for the next 20 years.
I'm on my 19th year of a 20-year
You are.
policy.
Okay, we're going to have to talk about
close.
that.
I shudder at what the premiums are going to be on renewal.
It's gonna skyrocket. Yeah, I'm just telling you now because now you're
telling the audience how old I am.
That's right. Sorry about that, but no, that is the truth.
Skyrocket, thanks.
And that's what happens a lot of times is that, and I'm not advocating one type of insurance versus another. I'm just trying to educate the public here. Generally speaking, if you have the money, you can do a better deal with the universal or whole life policies. But it's kind of tough because the premiums are very expensive. So what ends up happening is instead of paying, $200 a year, you might have to pay $2,000 or $3,000 a year. But it'll stay constant and it'll build up some cash value.
Which has a lot of value for the policyholder if they're going to need that insurance throughout their whole life. But for someone who might just need to bridge a gap for, the next, if something were to happen to me in the next 5 years, we're really going to need this money. But after 5 years, I think we'll be okay. We won't need any insurance. That might be where the term would be a better deal?
Generally, yes. But I'll tell you, in reality, what happens is, you have little kids, and so you say, okay, well, I only need this term policy for, let's say, 15 years. kid's 5 years old, go, when the kid's 20 years old, we don't need insurance anymore. But things change, and you start looking at your estate, and you start looking at, gosh, you know what, my wife really kind of needs this extra income to replace me if I'm not there. So definitely term insurance does have a place. And in fact, for me personally, I'll tell you what I did. I bought a universal policy, and I stuck $10,000 a year into that policy in my 20s. And I only did it for about 6 or 7 years. And I built up a lot of cash value. And basically the plan was I never had to buy insurance for the rest of my life.
Now, I know that was really popular in the 80s and 90s, because I know that we had bought a form of a universal life when they first came out, and they were promising some pretty high returns. But are those still worthwhile investments today? What kind of internal rates of return are you talking about?
That's an excellent question.
In this era of super low interest rates.
Okay, let's go back in time for just a minute. In the old days, in the 1910s, 1920s and all that, pretty much all they sold was the whole life type of policies. Mm-hmm. Then the insurance industry went through a change, and people realized, wait a minute, let's come up with a product where if it's just dirt cheap insurance and people could invest the difference, they'd be better off. And that worked for a number of years. Then in the late 1970s and early 80s, the insurance industry woke up and they said, you know what, we're losing a lot of business because people are just buying this deep, dirt cheap term insurance, and we really want them to buy this little bit more permanent policy, because otherwise people just keep jumping around from insurance company to insurance company, right? So they came up with this thing called universal life, which meant that, again, people would give the insurance company more money. And you're right, back then they were paying as high as 12% interest, and it was tax deferred. But nowadays, with interest rates low, the interest rates have dropped substantially. Now, policies I sold people back in the early 1980s had a guaranteed minimum of 5.5%. So they were earning 12 for a long time, and then it dropped to 11, 10, 9, 8, 7, 6. And now they're still earning 5.5%,
right?
Which is pretty
sounds
good
great
in
in this
today's
market.
Yeah.
It does. But again, I'm not trying to push people to buy one versus another, because what ends up happening is that there's a lot of costs that come out of those policies
Up front.
That's right. And so you really do have to look at the difference between, gosh, should I just buy term insurance and invest the difference? And I'll make it really simple for everyone here. The IRS has something called, or it's Congress basically, but it's called a modified endowment contract. And what that means is the IRS basically says, you know what, you can throw all of this money into into insurance and build up as much cash value as you want, tax deferred. However, wait a minute, this is too good a deal, right? Because think about it. Let's say you had a $100,000 policy, and let's say you could invest $90,000 in it and earn 3 or 4 or 5% tax-free. Right? That's a pretty good deal. Plus, you still have this insurance, right? Because you can buy the kind of insurance where they add the cash value to the $100,000.
So you
might get
190,
$190
yeah.
Exactly. Or there's different ways to do it. You could do it where you just get $100. Well, the IRS said, wait a minute, that's too good a deal. So they actually limit it and say, based on your age, how much you're going to be putting in, and for how long a period. If you put in too much money and it builds up it'll build up tax deferred. And if you take money out, then you'd have to start paying taxes and possibly a penalty if you're under 59.5. So what the object in that case for people who have the money, have a long-term need, and can they can afford it, is to potentially buy those universal policies and just figure out what's the maximum the IRS will allow me to put in, and go ahead and go that route. But again, they're very expensive. So what I've done is I've gotten a lot of clients into just the dirt cheap term policy, because nowadays people have a hard time coming up with money for their food, let alone their life insurance.
Right. Are these universal lives with I know that a lot of people were buying them for like annuity purposes, where
Correct.
you would invest in a universal life and you would put a certain amount of money into it with the idea that after 20 years you'd be able to collect a monthly annuity. Is that still a popular product today?
It is, yeah. If you've got the money, you could kind of kill two birds with one stone, right? Because what you would do is throw, let's say, $10,000 a year in for 20 years, build up enough cash value to where you could start drawing an annuity tax-free. And oh, by the way, if you die, your beneficiary would get the death benefit. Might be $1 million. So you kind of get the best of both worlds. So what one would do in that analysis is, am I better off to just buy a dirt cheap term insurance policy for $300 a year for 20 years and invest $9,700 in some other investment?
In the annuities, right?
In an annuity or something else, exactly. And when we come back from break, I've got a few more little secret tidbits to share with the listeners. So we're going to cut to our first commercial break here. And here is the question. And again, we're talking about trivia theme is unusual sports stories. All right, here we go. In the 2002 World Series, what San Francisco Giant picked up Dusty Baker's son who wandered near home plate? And we will be right back.
I remember when that happened, but I'm not 100% sure, other than the obvious answer, Barry Bonds.
Come on, Brian, you know this.
Joe Montana.
Do that, I like that. So, welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hanf and Brian Burke. And when we cut to the first commercial break, we asked this trivia question, and the theme is unusual sports stories. In the 2002 World Series, what San Francisco Giant picked up Dusty Baker's son who wandered near home plate? Brian, you're shaking your head. What's the answer?
I have no idea. My guess was Joe Montana.
Joe Montana.
I don't know anything about sports.
That is incorrect.
All right.
Mark, what's the answer?
I don't know. It wasn't Barry Bonds, was it?
It wasn't Barry Bonds. It was J.T. Snow.
Oh,
yeah. Remember him? Okay.
See, why didn't you think of that?
Okay, and we are in the studio with me. Because I'm the life insurance expert.
With Edward Brown.
Yes, there you go. We're going to try to educate the public, as they say. So, Mark, you're going to ask me a question.
Sure.
About the insurance company.
Bigger insurance companies versus smaller insurance companies, does it really matter which one I go with?
Generally it does, and I'll tell you, this is going to be kind of cool. All right, ready for this? Generally speaking, this is just a general rule. The bigger the insurance company, the worse they are. And the reason
At
is
what?
At giving the best price.
Oh.
Okay, and here's the reason. When you're a huge insurance company, you don't generally have to be competitive because everyone's scared. They think, oh my gosh, I can't go with
You're a market
ABC
leader.
company. I've never heard of ABC company.
That was my question is, will the smaller ones not be able to pay?
Okay,
So.
and get this, and again, this is kind of cool. Audience, listen in very carefully here. Except for the cases of like fraud, where you get some insurance company called Dewey, Cheatham and Howe or something like that, right?
That's a law firm, I think.
That's true. Well, that's true. First of all, there's maybe 2,000 insurance companies out there.
Really?
And there's a myriad of insurance companies you've never heard of, and they're perfectly fine. They've been around for 20, 50, 150 years, okay? So get this. There has never been a situation where a life insurance policyholder beneficiary did not get paid.
Really?
Now,
Never?
Never. And now, again, forgetting fraud for just a minute, okay? Because if someone wants to fraud you, that's one thing. But we're talking about insurance companies that have been around. And here's what happens is that if an insurance company gets into trouble, another insurance company comes in and buys out the business. So potentially stockholders, bondholders, and annuity holders can potentially get hurt because an annuity is an investment.
Right.
But a life insurance policy is totally different. So if you are, if some agent shows you a company you never heard of, don't be scared. Okay, but you really do have to compare the prices. That's really what it comes down to, is the prices. And I wanted to get into this also with the bigger insurance company. And you were saying at break how you kept getting churned from one company to another, potentially because of we got the greatest, biggest, newest
Right, here's
one
a
out
new
there.
policy that pays out even better, but we have to convert your old policy to a new one, which just ate up the little bit of cash value that I had created over the previous year.
Potentially, there could have been some legitimate reasons, but in a lot of cases, and this may or may not be the agent knowing this, that there are, even within the same company, there may be policies A, B, C, and D, but A pays the biggest commission. And so a lot of times the agents are concentrating on the commission, and what ends up happening is it just comes out of your pocket. So, like, personally, and this is a little plug for me. Okay, I'll be honest. I'm doing that for me. Is when I look at the insurance companies that I deal with, I don't know, 100 different companies out there, right? And I will just get the dirt cheapest life insurance premium for my clients, and I'll make sure that they're at least rated, A minus, let's say. I never even ask them what the commission is. Whatever it is. I just want to get the client the best, cheapest, dirt cheap life insurance premium with a company that's at least going to be around to pay them, right? And I never get backdoored by another agent. And in fact, I'll get to one really funny story here. A large insurance company that will be unnamed, actually their agent had bought a life insurance policy from me because I could sell them a cheaper policy than they could buy from their own company.
Really?
Which gets to the part about captive agents versus independent agents.
Right.
Because there are some insurance companies where you're considered a, quote, captive agent.
Right, you're representing one company.
That's right, exactly. You never want to deal with that kind of insurance agent. You always want to deal with someone who's completely independent, because you got to figure, if there's 2,000 insurance companies out there, what are the odds that one company they represent is going to be
that's going to be the best one.
the best? Yeah. And then the problem from an agent standpoint is the more business they do with that company, the more held on to they are by them, because if they leave, all those commissions that they could potentially earn when they retire are gone. So you definitely want to deal with someone who's completely independent. There's not a one-stop shop insurance company. I mean, I've had situations where I've had clients who had health issues. Maybe they had a heart attack 3 years ago. Well, that totally wipes out a whole myriad of insurance companies because they don't want to deal with that. Other ones are experts with regard to cancer. Other ones are smoker versus non-smoker. So what I wind up doing is, because I deal with a company, an independent company that just totally runs all the numbers and all the insurance companies, and I give the information to them. It's really simple. I just say, okay, Mrs. Jones is 62 years old, and she's looking for, let's give her a quote for a 5, 10, 15, and 20-year term policy, because she doesn't want to buy one of those universal ones, and she's been a smoker for 20 years. So they'll run the numbers and go, okay, well, these companies are way out there, forget that, and these other ones would be better.
That's interesting. So if you're doing an evaluation like that, is there a difference between term policies? Is one term policy any different than the other than the amount of years that you have a level premium?
No, that's the other beauty of this thing. Either you're dead or you're not dead, right? Because term policies is really simple. It's money that you spend for insurance. It's not complicated.
Yeah, it seems so simple.
It really is, and again, that's why I really like this part of the business, because again, either you're dead or you're not dead, and it really comes down to price. Again, because what I said, except for a fraudulent situation, which really is hard, you don't really get too many fraudulent insurance companies out there, right?
Yeah.
And it's easy to check out to see how long they've been in business. As long as they exist, then you just go with the dirt cheapest one. And the only thing that gets a little bit squirrely is, again, what if you're a smoker? Mm-hmm. Or what if you are a cancer survivor? Then, the one company that gave you the cheapest quote, if you're in perfect health, might not give you give you the best quote for if you have health issues.
So what kind of, do they still send a doctor to your house? What kind of qualifications do you have to
exactly.
do for examination?
Okay. I'm glad you brought that up. You almost never want to go with a company where they say, oh, no exam necessary.
Yeah, I see that a lot.
Yeah. And the reason that what happens is you get thrown into a big pool with people who are unhealthy. So the only people who should do that are people who are uninsurable effectively. They're going to die in 6 months, and it's like, no exam necessary? Okay, sign me up.
So typically that's going to be a higher premium policy.
Absolutely, yeah. Now, there are contestable periods, like within 2 years. So if you said, gee, I don't have cancer, and then you buy a policy and 6 months later you die of cancer, they're not going to pay.
Well, I know that when I got my term policy a few years ago, they sent somebody out to the house, they drew my blood, they did blood pressure, they checked medical records and all that. Yep. And then after the exam was complete and they got the results back, that's when they gave me my premium quote.
Correct.
Because they
That's
rated me in a better category than they initially rated me just by filling out the questionnaire.
Absolutely. In fact,
really?
the problem I had was my dad died at age 53 of a
Right.
heart attack.
Yeah, mine
And he-
too.
Right, and
Yeah.
then that's one of the reasons you got rated is because the hereditary type thing. Now,
Yeah.
in my case, my dad smoked, didn't get any exercise, and bad diet and all that stuff. But I unfortunately don't get the benefit of going, hey, look at me, I'm healthy, and I have better habits. So again, it goes back to each company is going to value you differently, and you absolutely want to go with one who, yes, it's a hassle to have them draw your blood, but they don't take out pints of blood. I mean, they take
Right.
out. It's so innocuous. It's just.
Yeah, they do it at your house. It's not inconvenient.
It's very convenient
Yeah.
at home or office, whatever you want, and you fill out the questionnaire honestly. You tell them, ever had any broken bones? Okay, yeah, I broke my thumb, when I was 17. They're not gonna rate
Oh
you
no,
on that.
broken down.
But if you lie on it, though, if you lie on an application, they can go after you. So it's really best to just put all your cards out on the table.
Or not pay. If you die, could they go look back and say, hey, you didn't tell us that he had chest pains?
And that's happened where someone had said he was a non-smoker,
Oh.
and it turned out that he was a smoker, and so the widow went to the insurance company. They said, well, we're not going to pay, and the widow said, well, why don't I just pay the difference between what the smoker rate and the non-smoker rate, because then that would be effectively telling
Right.
the truth. And they said no, and
Right.
and they went to court, and she lost. So it's better to just pay the correct amount, because
Otherwise, it's a waste.
it's yeah, exactly.
Yeah.
Yeah.
Is there a rule of thumb still on how much insurance one should carry?
That's a good question. The insurance company won't let you over-insure, and also you have to have an insurable
Really?
interest. Well, yeah. I mean, think about it. You make
I can't just-
20,000
I
a
can't
year,
just
and you
buy
want
$20 million
You want a
policy?
$10 million policy?
no, you can't do that. While you're wearing a suicide bomber jacket,
Right.
No, there are limits to
We're
that.
attending lots of Raider games.
Yeah, generally speaking, as a general rule of thumb, 10 times the amount of your income is fairly safe. But a lot of it's going to be premium driven,
Yeah.
right? I mean, if you just can't afford the premium, then you don't do it. I mean, but it's amazing how cheap this stuff really is, though. I mean, it's dirt cheap term insurance, and you want to get one. I would say that you really should get one for a good 10 to 15 years, because if you get one for 5 years, even though it's cheaper, it's amazing how fast it comes up. And then when you're 5 years older, suddenly you're a lot more surprised at how much the insurance is.
Especially the older you get, time goes by faster the older you get, I noticed.
Yeah. All right. So here's our second trivia question, and again, what's the topic? Unusual sports stories.
Unusual
Okay.
sports.
You guys will like this one.
Questions Brian won't know.
No, you might know this one. Okay.
Oh, okay.
In 1994, Tonya Harding was accused of hiring a hitman to take out the knee of her rival skater. Who was this rival skater? It's almost like Daytona 500, right?
Yeah, almost.
Okay, it's almost like NASCAR. And we will be right back.
I know that one.
You do
I
know
do
that
too.
one.
I actually
You
do
do?
know
You
well.
do?
I
Okay.
don't
I was
know how
hiding
long
my
it's been since
answer.
I've actually. Yeah, you have to hide your answer because I might copy off it. But I think I actually know this one.
Kramer,
which
you
is
know the
unusual.
answer?
No, but what was the name of the hitman?
Oh,
I can see him.
Guido. Okay, you guys ready?
Yeah.
Here we go. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with my co-host Mark Hanf of Pacific Private Money and Brian Burke of Praxis Capital. When we cut to the second commercial break, we asked this trivia question, and again, the theme is unusual sports stories. In 1994, Tonya Harding was accused of hiring a hitman to take out the knee of her rival skater. Who was this rival skater? Now, this time it's not Joe Montana, but you do know the answer.
Well, I think it's Nancy Kerrigan.
It is Nancy Kerrigan. That
And
is
I didn't even
correct.
copy off of Mark's paper this time.
that's
I usually
my
have to
answer.
look over there.
Well, I
and
tell you,
write it
it's
down.
pretty close to NASCAR, right?
Well, yeah, I don't
Skating.
know, is it? Oh, because they go in circles, right?
They go in circles, that's right. Okay. Mark, you had gone to an interesting conference. Tell us what's going on in some real estate.
Well, first let's talk about what's happening lately in real estate. Going back to the fourth quarter, there were an awful lot of long faces in the industry because sales were really down. The fourth quarter of 2011, in my opinion, may end up being the absolute trough in the real estate industry. And what I'm seeing is an awful lot of optimism in the market. In fact, I've been talking to a lot of real estate agents who are telling me that they've got an awful lot of more properties in contract right now than they had a month ago or several months ago or last year at this time.
But are they going to close now?
Well, yeah, that's it. So the statistics for new contracts are up, and then this report just came out yesterday. In fact, it says Bay Area home sales rose last month being January, to the highest level for January in 5 years. Now, the downside of that, if you want to look at this as a downside, we could talk a little bit more about that, is it goes on to say that the median price paid for a home fell year over year for the 16th consecutive month.
And guys, we're going to cut to our commercial break, and we'll be right back. Welcome. You're listening to the Best of Investing on News Talk 910. This is the show where we present valuable information about real estate, the financial markets, and other economic business of the day. For those of you listening for the first time, here's our format. A few guys sitting around a bar, talking business with you, the audience listening in. I'm your host, Edward Brown, and I'm pleased to have as my co-hosts Mark Hanf of Pacific Private Money, California's fastest growing private lender, and Lou Botmal. And today's trivia theme is Uncle on TV or in the movies. You'll understand when I get to the questions. Our website is bestofinvesting.com. You can email us questions at edward@bestofinvesting.com and listen for your questions on the air. We're also on television, Comcast 26 on Saturdays at noon and Sundays at 6 p.m. Now, today's guest is Dan Roberts, who is running for Congress. And although we're not a political show, we decided to have him on because he's going to discuss fiscal responsibility with us. Dan, welcome to the Best of Investing.
Thank you. Good to be here.
All right. Now, Lou, do you want to get in? You had some great questions you wanted to start getting in.
I told Dan before we started, I do work in the investment community, and there's a lot of things pending that need congressional approval or origination that I'm quite worried about, my client's quite worried about. So, Dan, I want to start off with, how can Congress restore confidence in the financial markets, and what's the first thing Congress should do to restore investor confidence?
Well, I've been working, by way of background, I'm on the FINRA Small Firms Advisory Board. I've been working for 5 years on regulatory reform with the Graham-Dodd Act and the Oxley Act, et cetera, trying to improve the markets. But you've got to begin, I think, where I begin. That is that these are private investments, are private contracts, so you got to respect that. I'm not sure that the Congress or the SC properly understands that.
Okay. Another quick question in regards to that. If you were elected, I want to ask this question, to Congress, what could you do to control the fiscal cliff that's pending, and what plan would you develop to get us through that period?
I think I begin with the point that what's going on now with the huge deficit, annual overspending, and the level of debt approaching 16 trillion and going to 20, I guess.
Yeah, what's a few trillion? Just wait till it hits a quadrillion, then I'll be worried, right?
Here and there, then it's real money, as Dirksen used to say. But so let's recognize there's a generational theft going on. Let's call it what it is. And that is, it's spending today that are actually the unborn are going to have to pay, and that's not right. Morally corrupt, and so when I go back to Congress, I will try to force the House and to face that issue. Secondly, with the near zero, we haven't talked about this, but the near zero rate investment environment, that's the shift that is penalizing the seniors, including me. I'm a senior. Because we can't get really an adequate rate of return, and it hurts all pension funds. You talk about one issue, the elephant in the room, is that why the pension funds are underfunded, can't match their actuarial assumptions, is that they can't get a decent return on their investments to match what they need in the future.
But if you raise interest rates, though, how's that going to affect the business environment?
It has to go to a market rate. It'll eventually have to go back to a market risk-adjusted rate.
Well, and if you look back 20, 30 years, I mean, the average prime rate was 6%. And we've been hovering, at 3 for how long now?
Forget the prime. What does the prime really mean? That's what the banks established.
Yeah.
Let's look at the 10-year treasury.
There you go.
Right.
10-year
1.7.
treasury. Yeah.
In fact, speaking of the banks, what I wanted to ask you is, what about the Glass-Steagall Act? First of all, explain
Right.
that to people
Oh,
and then
sure.
how things kind of shifted.
Yeah, in the 30s, there was the rewrite by the SEC in 38 forced the commercial banks to separate from the investment banks. So the huge risks that the investment banks take wouldn't be backed by the taxpayers, which is the situation today. So, I mean, I'd be a proponent of reinstating the Glass-Steagall Act to separate the investment banks from the commercial banks. The smartest people back there have been influenced by the banks. No surprise to this, that it's not possible to break them up and go back to where it should be. I think it should be. It should be
Is
reinstated.
that because of lobbying dollars, you think?
Surprise, surprise. The banks have more money than the people that I do, certainly.
Well, I know it's kind of strange that, years ago you'd go into a bank and all they would offer is just CDs. And then lately, the last 20 years or something, you go in there and now they're offering, stocks, bonds, mutual funds, et cetera.
Yeah, REITs,
And then-
everything.
Everything, yeah. And the consumer, though, I think is still confused, even though you have to sign a whole bunch of paperwork stating, I know this is not a deposit, I know it's not FDIC insured, and yet people, I still think, I'm in a bank, it must be safe.
So we're talking with Dan Roberts, who's running for Congress, and the district or the seat that you're running for again, what's
The
that?
second congressional district, it's a 6-county seat. We're in Sonoma, Humboldt, Mendocino, Del Norte, and Trinity.
And you're one of 2 people running, and as I understand, you're running as a Republican, but that's not what you would call yourself or you affiliate yourself with. Is that correct?
No, I'm more of an independent reformer, so I come out of the Ross Perot. I was concerned 1974, right, when Ross ran, about the level of debt. So I'm concerned today as it was then, more concerned today.
All right, you have a couple more questions.
Yeah, no, I wanted to jump in this one real quick. You're given your industry experience, and again, this is my business I'm in. I know you're in it as well. What changes need to happen right away in the next 2 years? I'd say as a time frame, because sometimes congressional races only measured in that vein because of the reelection process and who controls Congress. What can happen in the next 2 years to again bring what we need as a country and pay down the debt at the same time? There's certain services we do need and certain things we don't need. I understand that point, but what changes can happen? And is it obtainable? Like Representative Ryan, the vice presidential candidate, is saying right now, well, we can do it all. We can control spending, not raise taxes, and be okay. I mean, are you in favor of that type of view, or what would you do?
If you look closer at Ryan's plan, he doesn't balance the budget for about 20 or 30 years. So that's not doable. That's not an answer. I would say roll back spending to '08 levels and then cut 1% a year. We can balance the budget in a matter of a few years. So as I say, there's a moral problem here, spending the unborn's money, which is not sustainable.
Well, a question for you. How much power for the congressional seat that you're running for will you have?
Oh, that's a good question.
Thank you.
It's a
Thank
very
you.
good.
Thank you
I
very
bring that
much.
up on the road every time. I will sit in the majority in the House. How is that? I will actually have input. I will actually be on some good committees. If you have Democrat, if they give it to the Democrat, he's going to be what they call a backbencher. You know what that is, huh? They throw bombs from way far away with little impact.
The more you control, the more appointed you get. Let me ask you another question, going along with my line of thinking. America's lost its AA or AAA credit ratings. Now we're now AA, and given what you just discussed with us, the opportunity, as you mentioned, to pay down the debt, is that obtainable? Is it a real goal that we can see in our lifetimes? And what would it take to make that happen?
Well, the House blessed those folks that came in the House in 10 because they have held the spenders' feet to the fire. But unfortunately, the Senate is gridlocked. That's where the problem is. So there's no appropriations bills that have been passed by the Senate. They don't have a budget in 3 years. That is not sustainable.
Okay, guys, we're going to cut to our first commercial break, and before we do, last week we had a special trivia question, and here was the question. Almost 10% of us will do this in 2012. What is it? Anyone?
No idea.
Change insurance companies.
Oh.
Can you believe that? 10%, almost 10% of us.
Warren Buffett's betting on that with owning Geico.
That's right. All righty, and congratulations, George, in Walnut Creek. Okay, here is our first commercial break. Here's our first trivia question. And remember, the theme is uncle. Uncle, cry uncle. Okay. Name this uncle who was portrayed by John Candy in the movies. In fact, as I remember correctly, I think the name of the movie was this.
Yeah.
Okay. And we'll be right back. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hoff of Pacific Private Money and Lou Botmall of LPL Financial. When we cut to the first commercial break, we asked this trivia question. Name this uncle who was portrayed by John Candy in the movies. Anyone?
Buck.
Uncle Buck. That is correct. Okay, we are in the studio here with Dan Roberts, who's running for Congress. And although he's running for on the Republican ticket, you're not actually a Republican. You're more of an independent.
Independent reformer.
My kind of guy. Okay, Lou, you had a great question you were going to ask him.
I just wanted to touch on real quick, 'cause it's a polarizing issue, but the Obamacare and Medicare issues that are coming up. I know Republicans have a certain theory. You probably have your own. But what's really going on here, and how's this going to end up is really the question.
We don't know. You tell me who's going to win the presidency and the Senate, and I can give you some answers. But I start from a point that, let's go back to when we were discussing Obamacare. Really, insurance is a state's issue. It's not a federal government issue. It belongs with the states. Romney did something in Massachusetts, which he's entirely able to do, and I think California should have the shot at it. One size fits all may not work. It's a state's issue.
Talking, there's another law that's been talked about a lot. People always hear the reference to Dodd-Frank, which was a huge bill full of tons and tons of new legislation that was passed a couple of years ago. And and I'm a hard money loan broker, and I know my particular business has been impacted severely by lots and lots of new regulations. And what's your thoughts on that? And what
Frank and Dodd.
What kind of
used to call it.
What kind of work would you
Law.
do toward some of that legislation? I think many of the laws haven't even been written yet, based on some of what was passed in that huge bill.
I'll answer that by saying that the law has been written, but the regs have not been written.
That's
Right.
the
And so there's-
regulations. Yes.
Right, I'm a part and parcel of that because I work with the SEC and FINRA on this subject. So there's tens of thousands of pages of new regulations. All it's done is to increase the cost. It'll be passed on to the consumers eventually through the corporations or through taxations. So it's increased the size of the bureaucracy. One particular issue under Dodd-Frank is that they passed a lot of measures down to the SEC for rulemaking, right? One of which is the fiduciary rule, and I'm sure you're affected by this as well,
absolutely.
right? And so they've tried to create a dual fiduciary. You can't be a dual fiduciary.
Can't serve two masters, right?
That's right. You can't wear the same hat at the same time. I underwrite bonds and I sell bonds retail. I cannot be a dual fiduciary on that. So it'll either take me out of the underwriting, which I would not like to do because I create product. I'm about capital formation in my business. But they have no idea about what a dual fiduciary is about. It came out of this Dodd-Frank Act. They had no idea.
So you mentioned you are a small business owner, but you're also a military veteran, and you're one of the few military veterans running for Congress these days. Isn't that true?
Oh, there in California, yes. Nationwide, no. But in this race, I'm the only veteran who ran in the primary, and I'm the only veteran running now. So the point is, my argument might be made that maybe somebody that wants to run, ought to qualify to run by serving our country before they run.
Well, not only that, but just having a businessman. The country is a business, basically. And I think you need a businessman to run the country. Are you a
I'll
businessman?
answer that, of course, and for 26 years I've owned my own firm. So if we need a country a Congress that can balance the budget, learn how to create real jobs, not government jobs, right?
Yeah.
And not more free money, those days are over, then you need a businessman. That's the point that
But that's the thing is, you get these career politicians where their job is just to keep getting reelected.
Right,
And
fundraise.
Yeah, exactly. And you're not exactly like that.
No, I'm not, at my age, I'm a senior, so I'm on the same page as all seniors, but so don't worry about term limits with me, you don't need it, I'm not gonna be there for 20 years, I don't think.
Are you in favor of the McCain reform on fundraising for campaigns?
I'm afraid, Citizens United has blown a lot of that away, right?
Right,
So
yeah.
the money is wide open, but they haven't come to me yet, I'm waiting for them to call me with the money, it hasn't happened yet, so. I'm
Yeah, that's right.
waiting for my-
You've only spent, what, 60,000?
I spent 180 in the primary,
180.
mostly my money against 3 million spent against me, so ideas do resonate.
Well, that's the thing. Is like, so what do you think happened? Just people kind of could see through all that, and did they vote against the other guy, or did they know enough about you to vote for you? You know what I mean?
I attracted the conservative vote. I'm running as a conservative, and there was enough block there to carry me over the finish line. They don't call me landslide for nothing. I won by 173 votes out of 200,000.
Wow.
That's amazing. That's like one of those recount things that you have to do about 10
Yeah.
times.
Hanging Chad.
Oh, jeez, don't bring that
Dan,
back.
how much more difficult is it for someone like yourself, who's an experienced businessman, to run against someone who, as your opponent is a career politician? Isn't the deck stacked for the career politicians in this environment?
I'll answer by saying if money is speech, and I believe it is, that I start with a huge disadvantage, because the career politician, or one who's been in the assembly for 6 years in a failed state and a failed assembly, does not need a promotion, no name mentioned, and begins with the staff and infrastructure, right?
Yeah, but
and connections.
Well, that's the thing is you would think that there'd be the old, throw all the bums out type of thing.
Yeah.
Well, that's why they passed term limits, and so I wonder.
That's
do you-
Sacramento, though.
do
That's
you-
only Sacramento.
That's true.
Yeah.
But do you think in California term limits have worked?
I don't think they have. I think what it's done is given the staff most of the power in California, in my opinion, because the knowledgeable legislators are come and gone, right? And who stays? The staff.
Yeah, I tend to agree with that. I think I think the intent was good, but the outcome is not so good.
They just tried to get rid of Willie Brown. That's really what it was all about.
Oh, yeah, yeah, well, yeah. Well, I'll tell you, after failing as hall monitor in recess at third grade, I figured politics, forget it. I'm not going to go there.
Yeah,
It's not for me.
but sometimes people have to step up, right? If the need is great enough, right?
Well, that's what I was going to ask you.
Sacrifices need to be
See,
made.
how did you get into this?
I was incensed by Obamacare. I was incensed by the product and the process. The statement, oh, you've got to pass this before you can know what's into it. That's total, imagine that, that's nonsense. But the people
Don't worry,
bought it.
we'll fill in the blanks later on.
Well, that's what
Trust us, Dan. Trust us.
That's what they're doing now, by the way, aren't they?
Yes.
Yeah. Let's see, but I say to that issue, if the people of California, the second district, elect me, I will go back there to be their watchdog. I'm going to represent the taxpayers and the ratepayers, right? And not the people that have owned politicians for years.
Okay. Well, thank you very much, Dan. We're talking to Dan Roberts, who's running in the 2nd Congressional District, which, when is Election Day? November 6th. Very good.
It's a Tuesday.
Thank you. Yeah, it's usually, what a coincidence. It seems to always fall on a Tuesday.
Yeah.
All right, we are going to cut to our second commercial break, and here is the second commercial question, and it has to do with being, quote, uncle. Now, you have to be a little bit older to know this one. What was the name of the uncle on the TV show Bewitched? Again, what was the name of the uncle on the TV show Bewitched? And we'll be right back. Good.
Is that it?
Right,
Is
that's
that
it.
a wrap?
That is it.
Good, thank you. That was fun.
Welcome back to the Best of Investing. Again, I'm Edward Brown, your host, along with my co-host, Mark Hanf of Pacific Private Money, California's fastest growing private lender, and Lou Botmal of LPL Financial. And before we cut to the second commercial break question, Mark was reminding me that we have celebrated our 100th show. Been on the air for
100, that's
over
right.
2 years.
Our
Yeah,
100th
amazing.
Best of Investing show.
That's
Absolutely.
right.
Throw the confetti. That's it.
Throw the confetti, exactly.
Thank you, listeners, who've been with us
It's the
for
end
a
of the
while.
convention.
Yeah. Okay, here, the trivia theme was the word uncle. And what was the name of the uncle on the TV show Bewitched?
Uncle Buck.
Not Uncle Buck again.
Can I buy the center square?
Can you buy a center square? No, it was Uncle Arthur.
Uncle Arthur.
Played by Paul Lynde.
Paul
Hey,
Lynde, who's a center
played by
square.
Paul- He was a
That's
center
right.
square. That is correct. Oh, that's correct.
Hollywood
Okay, that's what
Squares.
you're. I
That's
thought
what-
you were
I
like
watched
buying
that
a
a lot,
vowel
too.
or something. Okay, we're gonna get right into email time.
We get credit for that now? Can I say at the
Yeah,
Lighthouse?
that's true. Exactly. Okay, Mark, we got an email from a listener who says, I talked to a hard money lender last month, but he wanted to charge me an upfront fee. Does your company do the same?
Well, the answer to that is no. And for new listeners, my name is Mark Hanf. The hard money lending industry, years ago, kind of had a different reputation. It was a different style of mortgage loan originator, and it was generally considered to be, the money of last resort. and people who were desperate, or there was something distressed about the borrower, or oftentimes they couldn't get money from the banks, and so they'd go to the hard money lender. It was very, very expensive to get, and some of the people who were in that line of work were less than scrupulous, and so things like upfront fees and bait and switch on terms. A lot of that stuff was pretty common, but nowadays a lot of those guys went out of business when the real estate market and financial markets went sideways in 2007, 2008. And so companies like mine that are new, we formed Pacific Private Money in 2008, and so we just passed our 4-year anniversary, and we've made over 400 loans to real estate investors in Northern California for the purpose of buying, fixing, and flipping property or collecting rental property. So generally speaking, we are now filling a niche that, unlike 10 years ago when people who couldn't borrow from banks, which was a very small slice, would go to a hard money lender and deal with that situation. Nowadays, it's the real estate investment community who the banks are no longer serving, or they're not serving them today. So the private money and hard money loan sector has grown in the last several years, and it's really a different type of industry today. So the good hard money lenders, the good private money lenders, they're not charging any upfront fees. So if you find a lender on Google or the internet or Craigslist or wherever, and they tell you that they need a good faith deposit or an upfront fee, you should run for the hills, because that's not what's that's, in my opinion, that's not what's proper.
So I guess in your case, you don't have to charge them because you keep your fees and everything low enough to where you give the borrower a good deal.
Well, you
still take the risk that they
first
might
of all,
not take the loan.
The Department of Real Estate frowns on upfront fees to begin with, so it's really gray area at best and illegal at worst to charge. One more thing about the upfront fees is that oftentimes they're kind of hidden. For example, I oftentimes talk to people in the Bay Area who contact a Southern California private lender because they're advertising, extremely low rates or
sure.
good rates relative to what other companies will quote. And once they hook you in and they get your application and all that, then they tell you, you have to pay us a due diligence fee, or we're going to fly up and look at the property. You need to pay for our travel and all of that. And so they start to kind of hook you in. You pay some monies. Then they fly up, they look at the property, right? And then they look at it, and all of a sudden the loan terms are, that doesn't really qualify for our 7.99% rate, but we'll do it for 12.5% and 5 points. And I swear to God, this happens all the time. And I get a ton of business from people who call me. They're 3 weeks in on a 30-day contract. And they're going, down the road with a Southern California lender for this great price, and all of a sudden find out that they either pulled out completely or the rate and terms completely changed. And so they'll call me up, and I'll have literally, 7 or 10 days, sometimes it's 5 days to close a loan, and they're desperate.
And you can still do it.
And we can still do it, yeah. So
That's
anyway,
good.
Don't pay any upfront fees.
Okay, and Lou, we got an email from a listener who says, I am looking for a new financial advisor. What should I look for when interviewing for one?
Somebody with hair. She's got a great head of hair. You can't tell, radio
Good-looking
audience,
guy.
Yeah. I'm jealous.
I was out with some buddies the other day. I go, "Who's got a comb?" They all looked at me funny. Okay. Essentially, this is a great question because it really gets down to one item, and that is so many people are paid differently in our industry. You say the word financial advisor, and you get several different opinions. They could be an insurance-based advisor, a stock-based advisor, an annuity-based advisor. They have certain nuances or things they do. So what you want to go do is say, hey, first question, what's your process? The next question I like telling investors to always ask them, can I get my money back? Wow, that's a novel idea, isn't it? Because what happens is a lot of people get these investments and they're like, oh, it looks really good on paper.
Yeah.
It could be an annuity-based interest rate or some other things, and they go, oh, your money's locked up for 4, 5, 7 years sometimes.
Yeah.
And I don't like people getting in that trap. I work as a fee-only advisor, which means when people give you their money, they can have it back the next day. That happened with a trust problem a few weeks ago where someone misplaced a trust document and they gave me the wrong one and we had to change the title. So, hey, there's no fees to change. Not a big deal.
Wow.
So, but some people work on a commission base, some work on a fee base. Again, insurance products come with some surrender fees. So how do they work? What's their process? Can I get my money back? What's your outlook? And does it agree with yours? I mean, this is the tough thing right now. Everyone wants to buy bonds and stay in the sand with their heads and say, I don't want to do anything. And say, you know, are there opportunities out there? Are there companies that might come around? Apple's up 70% this year. I don't think it's a buy recommendation at this point. It's just a stock I'm representing that, you know, hey, it's gone up a lot. If that's gone up so much, what's the next thing that could go up, or what's the next sector that could go up? Start asking those questions and engage them, and keep engaging them. The problem with engaging a new financial advisor is you have to stay on top of them. You got to call them. You have to hassle them every other day, like some of my clients do. But you do have to sit there and say, hey, let's talk every month, or let's talk every 3 months, or I want to come to your office. Yeah. That's very, very poignant, because you want to sit there as things change and say, look, I'm not comfortable with this. I was with a client the other day, and she goes, look, I need to be more aggressive. I'm working towards retirement here, Lou. I'm not working towards preserving all my capital. So let's change our thinking and not look for the next shoe to drop, but look for what the next encouraging opportunity
let me add one little caveat, because one of your questions you said, to get your money back. And,
right.
I'm assuming that you're not guaranteeing anything, because
No.
people can lose principal. So
Absolutely.
they have to know that it's not FDIC insured.
No, it's not. No, and that my intention.
I think you meant to say it was liquid.
It's liquid, and my intention is this: that there are certain investment products that have a thing called a surrender fee on them. Okay, and those surrender fees can stay around for a year, 2, 3, 4, up to 7 years. So before you make that decision, I'm not saying that doesn't work, but maybe for a portion of a portfolio it does.
Sure.
But some people sit there, I'm going to lock all this money up. It happens a lot with retirees. Here's my $1 million. Okay, I put it in 4 different annuities. Some surrender very soon, in the next year and a half, and some surrender 4 or 7 years down the road. Hey, that's great. Is that what you want?
I just wanted to make sure the listening audience understood that.
Getting your money back is important when you discuss investing, because in the end, things do happen. I mean, one thing I discuss about financial planning is I can write you a beautiful financial plan, and it's going to be outdated in 5 years. That's when you need to update it.
Oh, I
as they
remember
age.
the old days, $5,000 plans. You're going to have exactly 3.2 kids in exactly 6.4 years based on, and it's like, come on, stuff is useless.
Right, totally. And that's the biggest thing you run into is there's extraordinary expenses that occur in retirement.
Things
you might need a
change.
new roof. You might need a new car. I have some clients, their kids move back in with them. Their financial situation has changed, and this economy's done it to a lot of us, and it's unfortunate, but with 8.1% unemployment and low interest rates.
Lou, you've got something about quantitative easing 3.
Well, I wanted to talk about this.
Sounds like a disease. Go ahead.
I want to talk to listeners about all these headlines out there about quantitative easing, what it is, and the process involved, and how it might affect the markets in general. Many investors are now wondering, what's next, and should I allocate holdings, take advantage of the Fed buying one item over and over again? So, Mark, to your business, this is what happened with treasuries. They just start buying treasuries all the time. It floods the market, keeps interest rates very low. But the net effect of this money printing or money contracting business that the Fed's in, the economic conditions are weak, and they're just basically saying, hey, look, we need hiring to occur, and we need a certain part of the economy to kind of get on track, and that part of the economy is housing. So it's strange, though, we are borrowing money so other people will spend it, kind of like what the political candidate was talking about earlier. So that's a little bit of a problem, because the government, over time, will lose its valuation. When you print too much money,
Sure.
you lose value. So more inventories out there. Now, the good news is mortgage-backed securities are what's isolated to be purchased, which is great news, because now we have a ready market for mortgage rates to stay low. People are going to keep on buying those. Basically, the government $40 billion a month for a while. They also said we're not going to raise interest rates until 2015. Low interest rates are around for a while. So these bonds already yield between 1% and 2%. So I don't know how much lower they can go. It's kind of like treasuries, how much lower they can go. When you calculate inflation, are you really getting any return? And that I don't know. That's kind of a tough question, because we don't know where inflation is going. But right now commodities are low, so inflation is in place, mostly because China is a little bit unstable and weak.
But a lot of people, everything's based on alternatives, so people are thinking, well, if I don't get 1%, but I want to keep my principal,
Right.
where should I invest? And then,
Exactly.
of course, they talk to Mark and find out they can earn, pretty conservatively 8% interest, and they go, holy smokes.
So hang on a second, Lou. Let's break this down for a second. So interest rates are already low. Mortgage rates are 3.5%. So what's the practical goal of Bernanke in doing this new round of quantitative easing? What is he hoping is going to happen specifically in the marketplace?
Well, I think that the last quantitative 1 and 2 you refer to as stimulus. That's money that's injected directly into the economy. And what they're doing here specifically is they're saying we want mortgage rates or housing to remain stable or go up. They're really nervous that, because from an employment tool, I think there's stats out there, like I know in the automotive industry, 1 out of every 6 people is in the automotive industry. Look at housing between, what you do, conventional mortgage lenders, inspectors, salespeople, and the turnover of real estate, people who improve it and employ so much of this country. They think it could be a driver to really bring unemployment down. Now, it's interesting you should ask that question, because the one point I wanted to make, if I can jump there real quick,
Sure.
is, he kind of telegraphed this move. He's like, there's only certain,
Okay.
there's only certain things I can do. But what he's really done here in the depths of everything, politically, he's put a ton of pressure on Congress, the Senate, and the President, saying, it's your problem now. I've done my job. You guys keep on beating me up to do something. I've done it in a conservative fashion, because it's just regulated to the mortgage industry and to telegraph the fact that interest rates won't go up till 2015. So now it's like, okay, the next step is yours. If we fall off this fiscal cliff, if you raise the tax on dividends, the tax on capital gains, whatever you might do, these are your decisions to make. He's not a political animal. He's completely independent. But it's now their job to get us over the hurdle. That's why the next, 100, even after election, 150 days are so critical to all these decisions we make. How companies will invest, how a lot of things will occur.
I was surprised to hear that statistic about 1 out of every 6 people is in the automotive type industry. And I know
Right.
you're not talking about just building cars.
No,
It
no,
has to do with everything.
Yeah.
Well, I wonder what it is for real estate.
Oh, it's huge. I think it's even more.
Well, and so just to get back to, what's the goal? Is the goal that banks are going to make more loans? Is that banks going to make lending easier? Because I don't see, and I'm not hearing that getting a bank loan is going to get easier, and I don't see or hear that banks are going to start making loans to real estate investors to buy investment property again. So I'm wondering which
is good for you.
Where's the stimulus happening? I mean,
Right. That's a great point. So, right, there's less people qualifying for loans. There's still people in foreclosure or loan modifications and all these programs that are basically are not working. That's real estate that's not working. But again, back to the point, that's on the political side of the spectrum. They need to regulate banks so that they do start lending. They do start making things happen. They have to lower some of the restrictions that are out there with some of these banks. Their capital requirements are a little high. Things need to be fixed. Remember, AIG is still owned a lot by the government. There's a lot of things that are still owned by the government. So he's saying, like, this is going to bring a calmness. Everyone's going to settle. It's not a hey, let's jump in. Remember 2010 when this happened? Everybody jumped into the market because that was regular stimulus. That stimulus that goes throughout the whole economy. He's saying mortgage rates will be low as things get fixed, like unemployment, like the tax policy, like these things. We know the mortgage system will be attacked, so housing will continue on the trajectory of rising steadily.
Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.